Greetings from FinstudyClub. My name is Ankur Kulshrestha, welcoming all viewers to a very important session from cash flow statement, wherein we were going to talk about the movement from the indirect method to the direct method. Now, before looking at this particular aspect, it is very imperative that we have looked at the following sessions, starting the overview of cash flow statements, wherein we talked about the direct method. Thereafter we talked about the indirect method, and only then we would be able to talk about how to convert an indirect method into the direct method. Before starting, you would be aware that the direct method can be applied for financing, investing, and operating cash flows. So in this particular video, we are going to focus only on the operational aspect. Okay, and in my next session, I'm going to focus upon the same and similar techniques, but the focus will be on the non-operating, which is the investing and financing cash flows. So let's just try and understand what do we mean by the the phrase called conversion of indirect method into the direct method. Well, you are aware that in case of the indirect method, which is obviously used only for CFO, the starting points, or should I say the raw data that I need, is the income statement and the balance sheet. Using that, I'm going to apply 4 steps and all that jing bang to convert my PAT into CFO. However, the starting point is my PAT and the balance sheet. The only challenge with the indirect method is that it is not a very good method for the reader's point of view. However, on the other hand, my direct method is a very good method from a reader's point of view. The only thing is it takes a lot of time. So I am basically trying to combine both the objectives, wherein my hard work is lesser but the representation for the user is very good. So therefore, basically what I'm trying to do is I am trying to use the information given for indirect method, and finally I want to present the the cash flows according to the direct method. So actually it is using best of both worlds. So while the information given will be much more neater, cleaner and manageable, which is PAT and balance sheet, and on the other hand the presentation will be absolutely as per the direct method. You can look at the cash flows on the face of the cash flow statement itself. Okay, so let's just say what does the slide has to say. It says we're given the income statement and balance sheet in place of a bank statement. Obviously, that's a typical direct method, and the income statement and balance sheet are the inputs which are required for the indirect method. So what we are saying is that income statement and balance sheet are more useful for CFO by the indirect method, whereas in this approach, this is a bridge between the indirect method and the direct method, wherein we will try and create should I say a connect between the two. How do we do that? It says we are going to select the operating items from the income statement. Now bear in mind that these items that I'm going to select are the items which are in cash by nature. What I'm trying to say, I will find depreciation also in my income statement, and everyone knows that depreciation also is an operating item. However, I am not going to select that because by nature that item is non-cash. So here, deliberately the objective of not writing it was to explain it while doing, and I'm sure that viewers are noting this point very carefully. I'm going to illustrate that using an example in my next slide. Now, once you have selected all the cash, by nature items which are operating from the balance sheet, from the income statement, I am going to calculate and convert their cash counterpart on the basis of different relationships, from the balance sheet values. So what I'm going to do is there is an income statement and there is a balance sheet. There is an item called X here. So I am going to come back to the balance sheet to find out any asset or liability which is related to X. If I get one of those, I am going to use the relationship between these asset liability and X to find out the cash counterpart of X. My problem with income statement is it is accrual based, so therefore the value of X here will be on the basis of accrual, whereas I need something in cash, so this relationship will be exploited to that extent. Okay, now the presentation that I will eventually get is the presentation, like I was saying, will be absolutely similar to the method which I would have got if the bank statement was available to me. So the short point is, my face of it, the front end, will remain same, whereas my back end will change. So the back end has changed for good, where we are using a lesser taxing method to calculate your direct cash flows. What is very very critical, and like I said at the beginning, that this session will focus more upon the operational aspect. You're aware that the direct method can be used for investing, operating and financing both, but right now I'm going to focus only and only upon the operational aspect. Moving to the illustration that we have, so this is going to be my entire database that I'm going to use, and obviously I have dissected and bisected that into different smaller questions. Now what I meant at the time of explaining selection of the operating items which are by nature cash is, look at these items which are there in the income statement. Now all those who have looked at the direct method will be able to appreciate that this is the same example that I had taken to explain the direct method, and I've used the same too, so that we can derive some parallels to it. Now here what I'm trying to say is, look at these items: number 1, 2, 3, 4, 5, 6, 7 and 8. There are 8 members sitting in the room. I want to select the items which are operating and by nature cash, so I'm going to select sales. COGS is also operational and needs to be paid in cash. The salary, again operational and needs to be paid in cash. Depreciation is actually operational but doesn't need to be paid in cash. Depreciation, again, loss on sale of furniture is not operating, therefore will not be selected, and preliminary expenses as well. Taxes, again, needs to be paid in cash and is operational. So overall I've been able to select 1, 2, 3 and 8. So short point I'm trying to drive home is that my starting point is selection of those items, which I have done by selecting 4 specific transactions which are there in my income statement, 1, 2, 3 and 8. Now I'm going to hold these 4 and select each one by one to find out the actual cash flows using the relevant balance sheet items. So what I mean by that, let me start by focusing on the collection from customers. I'm going to calculate the cash counterpart for the sales, which is cash collection from customer, in 3 manners. Like I was saying that this portion will be matched with the corresponding balance sheet item, which is the debtor in this case, and therefore the cash counterpart can be derived. So I'm going to explain that using 3 methods. First is the most easiest and convenient method of making a ledger account of account receivable. Now all those who have done commerce or have made these accounts will appreciate this, the most important and should I say the simplest of all. So your opening method account receivables are 15,500, your closing are 16,800. You have sold to the same people worth rupees 45,000, and your cash collection, the balancing figure on the credit side, there are 2 sides, debit and credit. Account receivable, when increase, is debited, and when decrease is credited. These are simple rules of commerce. So I am going to find out the net cash collection, which is going to be my balancing figure here, which by doing a quick math is 1300 less than 45,000, which is 43,700. So my answer is 43,700 cash collection by my first method. Now let me explain the same thing by a very very logical method, and this is for non-commercies as such, I am basically trying to think that I already had to collect 15,500 from some people which are called as debtors, and during the year I have sold goods worth rupees 45,000, assuming 100% on credit. Therefore the total closing which should be is 60,500, whereas my actual balance of my balance sheet is only 16,800, which is possible only when I would have received a cash of the balance, which is 43,700. So again I've been able to arrive at the same number using a much more logical process. The logical process says your opening balance was this, that means this was recoverable from the previous year. During the year you have sold these guys further 45,000, that means the recoverable total should be 60,500 in the balance sheet, but your total balance in the balance sheet actually is appearing only 16,800, which is possible only when during the year you would have received a cash of 43,700. The third method is equations like these, which is not recommended upfront. This is not recommended, but nevertheless this is given in the curriculum and different financial literature, hence they instinct to kind of cover these up also. So I'm going to basically use one of these equations. Here I'm going to write my debtors or the receivables are going up, so I'm going to use the first part of them, which says your sales is 45,000 reduced by the amount of increase in the account receivable. So again, if you will look at, my answer is 43,700. So answer by all the three methods is same. Let me go back to the initial thing where I had said that to calculate cash flow by the direct method, all I need is an income statement and a balance sheet, from where I will pick out the operational item by cash, try and calculate their cash counterpart on the basis of different relationships in the balance sheet. And that's exactly what I've been trying to do here. Okay, now let us try and explain this particular equation and see how does it is it similar to or is different than the first two. Actually all three methods are absolutely same. If you try and look at the way I calculated this balancing figure is 15,500 plus 45,000 minus 16,800. That's how the balancing figure will be arrived at, and that's exactly the logical process that I've done. 15,000 plus 45,000 minus 16,800. It's just that the logical process has a story being carved around it, whereas the ledger balances are basically the rule based. If you look at what I am trying to do is I am doing opening plus the sales minus the closing. If I shift opening and take negative sign common, what I get is sales minus closing minus opening, because opening plus and I have taken a negative sign, so negative negative positive. So what I'm trying to say is, by looking at it in this manner, sales minus closing minus opening is change as in increase in the account receivable, which is nothing but this equation. So in a way all three are similar, and I'm sure that we would need to practice this a bit more. Let's try and pick up the second cash and operational aspect, which is expense. So I am choosing the second item, in fact actually the third item. Let's say the salary accrued, which during the year payable was 2,000, and if I look at the relevant aspect in the balance sheet, it is your outstanding salary. So my point number 3 is actually related to outstanding salary. Okay, so moving on to our main example, where there is a outstanding salary in my balance sheet. Again I will do it by all the three methods by creating a ledger account of outstanding salary, which is your opening. Now, outstanding salary is a liability, and liabilities generally have credit balance. So, opening was 4600, your closing is 5400. During the year, your accrual salary is 2000, and the balancing figure, whichever is going to come here, is this. So, it is 6600 minus 5400 is equal to the total cash paid figure of 1200. So the total cash paid by a ledger account is 1200. Now, as you can appreciate that sometimes for specifically for non-commerces, this seems to be a bit confusing. So let us have the same thing by the logical process, wherein I am trying to say that I already had to pay 4600 rupees for the previous year's salary, and the current year's salary, which has further become due, is 2000. So to speak, my total due should be 6600, whereas my actual is only 54 in my balance sheet, which is possible only when I would have paid 1200. So as you see that my answer again is coming out to be 1200. This is the most preferable method in that sense. And the third point, which is, like I said, is not so preferable, is the expense accrued is 2000. There is an increase in the outstanding expense, so I got to put a negative sign, and the increase is by $800. So you got to understand that increase is to be subtracted and decrease is to be added. And since it seems very, very confusing, hence I never recommend never recommend this particular method to any student as such. So the answer, although will always be absolutely same, that's not the point. Point is to do the same in a very, very logical manner. Now in this case, I'm just going to divert a bit, and I am basically using the similar figure. The only changes that I have done is, rather than outstanding salary, I have prepaid salary. That means I am paying to my employees in advance. So again, I'm going to kind of make a ledger account for an asset. Point to be remembered is that a prepaid expense is an asset where the opening balance is, let us say, 4600, closing is 5400. Your asset increase once you pay the cash, and they reduce once you consume from it. So let's say it's almost like a prepaid talk time, where you had this much balance at the beginning of the month. You have recharged it further. Now recharge will entail cash outflow, and you have had the consumption of 2000, and this is still closing. So if I do a quick maths, my recharge amount in this case is coming out to be 2800. So my total salary paid in this case is coming out to be 2800. Let's try and do that with a logical method, which is almost like the way I have explained is, let us say I already have a balance of 4600 as advance being given to the employees, and I have further given cash worth rupees X. So that means there is a total amount of 46 plus X. That should be the case, whereas during the year they have rendered the salary of 2000. Therefore this has been the consumption, as a result of which my total my closing balance should be 2600 plus X, and the closing balance is coming out to be 5400. So this is 5400 is equal to 2600 plus X, where X is equal to $2800. So again, the answer is coming out to be $2800. I can relook at it from the third point of view, which is the least recommended point, is 2000. Now there is an increase in the prepaid expense by 800. So 2000 add any increase in the prepaid expense is plus 800. So the total, cash paid, collection oblique paid, so it is cash paid is 2800. So the answer by all the three is, this time as well is similar. Let's come to a very, very important aspect of cash paid to supplier, where one of the items from the income statement is COGS, and the balance sheet items are twofold, which is one stock, which is inventory, and the creditors, which is accounts payable, Okay. What we need to understand, not to say this is not important, this is actually very, very important, that it's a two-step. The first step is COGS will be converted into purchases, and which will be further purchases converted into cash paid to suppliers. This adjustment is done by using my inventories here, and this step is done using my accounts payable balance, which is here. So this is relatively important step in conversion of the indirect method to the direct method, wherein what you have in income statement is COGS, and what you need for cash flow statement is cash paid. So done in two steps. Let us quickly jump on to the first step, which is using the inventory balances. How can you convert a COGS into purchases? And for that, I will remind the basic inventory equation, which is your opening plus purchase is equal to your closing plus COGS. Not only this is a basic inventory accounting equation, you can also create the same thing like I had said by making the ledger for the inventory. Let us put in the figures in the equation form first, which says 12,000 is my opening inventory. Let purchase be X is equal to your closing is 11,000, whereas your COGS is 30k. So that leads to X is equal to 29,000. If I were to do the same thing, I have opening inventory of 12, I have a closing inventory of 11. My purchases will be obviously adding to my inventory balance on X, and the consumption, which will reduce the inventory, is 30. So effectively I'm going to get the same number of 29. So I have arrived in my first step, and from 30,000 of COGS I have jumped to a purchase of 29. Now I'm going to follow pretty much the similar process, step 1, explanation 2, or the equation form of 3. So if I were to make like a ledger account of accounts payable, my opening accounts payable is 2900, beg your pardon, opening is 2900, which is right here. Your closing is 3100, which is here. During the year you have made purchases. Now accounts payable have absolutely no relationship with what you're consuming. What they are bothered is how much you're purchasing from them. So your 29,000 is the purchase, and the balancing figure is the cash paid to supplier, which by doing a quick math is coming out to be 28,800. By doing the logical process, I can also calculate that I had to pay $2,900 to someone from whom I have further purchased goods worth rupees 29,000. That means my closing should be 31,900, whereas my actual closing is equal to 3,100, which is possible only when I would have paid them 28,800. So by the second method as well, it is coming out to be 28,800, and I'm very sure that we can formulate a equation for them as well, which is like your cash paid is equal to your purchases, which is equal to 29,000, as reduced by increase in your accounts payable. So your increase in accounts payable is 200. So 200 deducted from 29,000 will give us 28,800. So by all the three methods, I am again able to arrive at this. So I'm sure that the conversion method from indirect to direct has been helpful and useful. We look forward to speak to you on so many other different topics which are very critical from exam success. Should you want us to take up any particular topic before it comes in a logical sequence, we'll be very happy to do that. Should you have any query, any doubt, any questions, we'll be extremely happy to address those at finstudyclub@gmail.com. This was Ankur Kulshrestha from FinstudyClub. I look forward to speak to you in my forthcoming sessions. Thank you.